And the markets once again look to China. That's what we're going to focus on here today on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And while we've had a blistering set of gyrations in Chinese economic markets over recent weeks. In fact, the story there has dominated headlines and at times even overshadowed the likes of the Federal Reserve or the twin wars raging in Ukraine and the Middle East. But now we get another major chapter, and we are going to get a good, deep look here at where this story has gone this week, what the economic data has shown us at this point, and then consider what comes next, because it is a major data day for China and a major inflection point in this narrative directly over the next 24 hours. We'll conclude with some trade setups, look at how we can actually take these ideas into the markets and implement them. So let's begin with the wild ride that was the Chinese stock market in the latter part of September and going into October. Needless to say, this is an absolutely bonkers chart. We have here a mere 6 days of this rally, giving us a rise of close to 40%. And then a seesaw, whereby we have now erased more than half of that move. So what in the world is going on? Well, needless to say, the unveiling of stimulus was a big part of this story. And it wasn't just that the central bank came out and lowered interest rates again and cut mortgage rates and said that it would spend more money on boosting stock markets, which we can see, of course, ahead of this rally, were kind of slowly bleeding out on the downside. This, of course, ASHR, the ETF that tracks China's benchmark CSI 300 index. That's the biggest and most closely watched names on both the Shanghai and the Shenzhen exchanges taken together. So they come out, they dump more money. They cut the overall cost of borrowing at the 7-day, at the 1-year rate. They reduce bank reserve requirements, so more capital is made available. But that's not really what the markets get excited about. Perhaps it's not even that they allocate more money to just buying stocks directly. Because, of course, all of this has been tried. China has thrown all manner of monetary inducements at the economy for years at this point, both through the COVID pandemic and thereafter. All of those efforts have largely failed. And that's because what we have in China is a fundamental lack of demand. A survey by the PBOC itself in the second quarter revealed that when asked what they would do with any extra money, respondents by a margin of 58% said they would save it rather than spend or invest. And therein has been the issue. So when you offer the markets cheap credit and say, won't you please borrow, and then that will stoke demand, what you're hoping for is, of course, that the signal will be taken at face value, that people will listen, that the inducement will work. But in China, it hasn't. And so market watchers have for a long time at this point looked at this and said what needs to happen is fiscal stimulus that actually creates demand. The government needs to come out and spend a bunch of money to push the economy back to life, a kind of jump-starting wave of spending. And the meat of this rally that we're looking at here follows some initial sense from the Politburo, the 24-member ruling core of China's leadership, including President Xi Jinping, that they finally come around to this idea. They'd been resistant to use this kind of approach before. Xi Jinping didn't want to wade in and, in his words, upset Chinese consumer self-reliance. They were talking a big game about they wanted quality growth. So they wanted things not just based in government spending, but in underlying demand. And the results are what they are. The economy has been anemic now, and monetary stimulus hasn't lifted it out of the doldrums. So when it seemed like there was a bit of a head change, there was this massive rally. And of course, since then, it has disappointed. At the top of this week, the Ministry of Finance made an announcement and said basically what would amount to a fiscal-like effort, all of which essentially came down to giving money to municipal authorities to clean up their debts, ostensibly so that their books are rebalanced to a better state so they could borrow more so they could spend. And then efforts to help those municipal authorities fund purchases of idle land and empty commercial buildings. Again, seemingly in a way inducing spending or creating the conditions for spending by everyone except the central government. And that, of course, is exactly what the markets wanted. They wanted the central government to create demand directly. And once again, somebody missed the memo. So what we've seen is continued disappointment. The flow of economic data this week against this backdrop has only made things worse. Consider what's come out. Here are the numbers on the menu this week, those already out and those that are still coming up. And of course, this right here will be where we find our catalysts and the impetus for a trade today. So, top of the week, in fact, over the weekend, inflation weaker than expected, both at the consumer level, CPI, and at the wholesale level, PPI. Let's consider this in context. CPI unexpectedly down to 0.4%. That's the lowest in 3 months. Last time we'd have to go back to June to see numbers like that. Wholesale inflation even more abysmal. That's down here 2.8% year on year, so deeper into deflationary territory and the weakest we'd seen since March. So all of this pointing again to the absence of demand. When something is on discount, that suggests that things need to be lowered in price to clear inventory because nobody is buying. And that's precisely what we're seeing in this perpetual weakness in inflation data. There is simply no demand to pressure prices upward. It gets worse. The trade numbers that come out give us much weaker export uptake than expected, 2.4% year on year versus 6% expected and 8.7% in the prior reading. Imports barely grow at all, 0.3% versus 0.9% expected. Let's put that in context. That is the worst export growth since April. And for imports, that's the worst number since imports fell back in June. It continues to get worse from there. The same day, we get loans data. And here, the real takeaway is, sure, you get a pickup in loan growth. It was 900 billion in new loans in August, and it was almost 1.6 trillion in September, but that was less than expected, which was 1.8, 1.9 trillion. But perhaps the most damning bit of all, the outstanding loan growth rate So the actual growth in loans, not just the total, but the growth in credit, even with this vast amount of monetary inducement, fell to 8.1%, which is the slowest loan growth since at least 1998. In other words, it's not working. You can provide all of the cheap credit in the world, but if nobody wants to borrow and spend, they're not going to. And that is precisely what we are seeing here. Now, the next shoe to drop is going to be the third quarter GDP figure here. In conjunction, we're going to get retail sales numbers. We're going to get industrial production numbers. And of course, we're going to get house price numbers. This is a huge story, of course, because so much of China's malaise is linked to the unraveling of the housing market, into which virtually everybody was heavily invested. Individuals, corporates, municipal authorities, and of course, none of them seem to have any money to spend on much of anything, hence the absence of demand, as their investments, primarily in the housing market, evaporate. So what we're looking at here is another big data dump. And if we look at the way that Chinese economic data has been going, as though this week were not indicative enough, Citigroup tells us that the news flow here has been deteriorating relative to expectations since mid-April. And while the US, for example, has seen a bit of recovery in recent economic data, having also followed a similar decelerating path from around mid-April, late March or so, here, no such luck. We remain deeply below the zero line, and we're not improving, which suggests that we are at this stage still facing expectations coming out of economic models for China that are meaningfully rosier than reality is endorsing, and also that reality continues to be essentially anemic beyond any sort of help. Because not only do we still miss relative to forecasts, we're not even improving in relative terms, whereby the misses start to get shallower and expectations start to converge. Even if analysts' models are being revised, let's call it from mid-August through to now, to reflect a weaker economy and to introduce that into expectations, the economy itself seems to be making sure that even those things are rosier than reality would have it. And so the risk of a downside surprise as we get into this GDP report seems to be significant. The expectation for this headline figure that we're going to get a second consecutive quarter of slowdown from 4.7 to 4.5% year on year. And of course, the assorted numbers coming with it may likewise follow down this path. What all of this boils down to is the central issue facing China. And it really all seems to be distilled in this one chart. In the yellow is nominal GDP growth, measured as the real growth in the value of goods and services in China, plus inflation. So the impact of rising price levels. Real GDP, the thing in red, takes that inflation component out and says this is just the value of goods and services minus the increase in their price. Notice here, this is not working the way it should. Typically, nominal GDP, that is real plus inflation, is above real because inflation is positive, which is what's supposed to happen in an economy that's growing. Because that means rising demand has limited supply getting chased and bidding up the cost of things. This is why central banks, for example, aim to target a positive 2% inflation rate, because that is what a healthy economy exhibits. Zero inflation or negative inflation would be terrible news. It would suggest an absence of demand and of economy-wide discounting. And as it happens, that's exactly what's going on in China, because what we see here is that real GDP is growing faster than nominal GDP, implying that inflation component is indeed negative. In fact, we see here it's been negative now for 5 consecutive quarters, all of which suggests a gap, staggering though it is, of close to 1 percentage point of quarterly GDP growth over about a year and some change here, implying essentially an economy without demand to speak of. We may well, with the kind of disappointment that looks like a very live risk here on this GDP report, end up with a 6-month direction. And what's interesting, of course, is how to trade that. Now, the temptation, of course, is to look back at this, but here things might get a little fuzzy. Onshore markets are very much in the purview of local officialdom's decree, and they could essentially mandate them higher. In large part, capital flows don't flow freely in and out of China, and these markets are relatively less liquid, with foreign capital having fled the country over recent years. And so the ability for officials to essentially send the sovereign wealth fund, the quote unquote home team, out there and just buy local shares and arrest any kind of significant price transmission mechanism is very much on the table. Those kinds of theatrics have been seen before and could certainly be seen again. Rather, looking at a proxy asset like the Australian dollar might be a greener pasture. This has been interesting, along with copper, for example, because as Chinese shares were soaring, these assets outside the purview of onshore mandate making, they did not confirm the move. Notice there is not a dramatic spike higher here in Aussie dollar the way that there was in Chinese shares in the tail end of September. Instead, there was fizzling disappointment. We continue to decline here. And of course, the reason we look at copper is because China is its number one buyer. The reason we look at the Australian dollar is China is its largest trading partner. And the things that Australia sells to China are so very fundamental to its economic growth. Its largest exports are the iron ore that's needed to smelt steel and the coal that's needed to burn to generate electricity. So this is really fundamental China growth engine elements, and that, of course, makes Australia very, very sensitive to China's business cycle. Its mining industry is overwhelmingly dominant. And so what we have here is a real indication that the markets outside of where Beijing could effectively tell them what to do, showing skepticism in this entire narrative. Most recently, of course, we've taken out the 67 figure. There was a bit of a pop from yesterday into today around some slightly better than expected Australian employment data, but we'll notice that the move has not come back over 67 and held that with any kind of conviction. In fact, we retested the underside and have pointedly held. Next key levels of support coming in at this bottom here at 66.23, then 65.78, so kind of clustered around the 66 level. And if we take that out, then a test below 65 down into this area and perhaps eventually even down to these lows down here under 64 is certainly not outside of the question. And if we were to take back 67, then 68 comes back into the forefront, but the path of least resistance, especially if this Chinese economic data continues to look as sour as it has, seems to be pointed lower. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at where the Wall Street close has landed us and what might come next. I'm back with Chris tomorrow for Futures Power Hour, on with Victor Jones for The Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting on the platform formerly known as Twitter at Ilya Spivak. If you're watching this on YouTube, like and subscribe. Macro Money is back next week. Happy trading. See you then.